Welcome traders, this is for Pti Trading Institution. I welcome you to this wonderful video. So I'm just going to be teaching you how to apply moving averages into your trading. So what you need to know is that there are different moving averages. We have exponential moving average and we have simple moving averages. So when it comes to these two moving averages, a lot of people, they think that they are the same, but however they are very, very different. And what you need to know is that, okay, when it comes to, let me start with the simple moving average. When it comes to the simple moving average, you need to know that it only plots past or previous data based on previous data. However, the exponential moving average, it also plots based on previous data. However, it is also changed, or it is also affected by the current data, meaning it is more updated than the simple moving average. So you can have an exponential moving average of period 14 and a simple moving average of period 14. However, you will have differences, because this one, it will be also looking at the current market data. This one, it will only be looking at the previous market data. So those are the differences. And when it comes to the period, it is what determines the number of candles that will look going back, meaning if it's a 14 period moving average, we are going to be looking at 14 candles back, and then we plot the move of the market. For an example, this red moving average, it is the 14 period moving average. So what it does, it looks 14 candles back, and then it plots a point. 14 candles back, it plots another point. 14 candles back, it plots another point. And when the points are joined, they form this red line, the moving average. So I'm just going to be showing you how we can apply these moving averages into our trading. I know a lot of guys, they are familiar with this moving average applied as a strategy, applied as a trading system, but I will just give you few options through which you can apply this wonderful tool. So the first option, it is to determine your entries. You can apply the moving average to determine your entries. So how can you determine your entries? You can determine your entries by moving average crosses. So when the moving average cross, but then now the secret is that it is not at any point that you can use the moving average crosses. It is not every point. So I recommend that you use these crosses in a significant level, meaning in a major supply and demand zone, or support and resistance. For an example, when the market is moving like this, then that's where you can apply the moving average crosses in these key levels, in these key points where the market responds, where the market has been responding even in the past. For an example, let me just check where we can have a multi confirmed support and resistance, like key levels where the market responded. Maybe, okay, let's just use these levels, like here in these levels, here in these levels, here, and this level down there, meaning when the market in the future approaches this level, because we know this is a significant resistance level, the market has been going for a long period of time and it was resisted even for a long period of time. So it is a significant selling level. So when the market approaches this level, that's where you can use your moving average crosses to take your entry. So I hope it is making sense. Even when it comes to trading ranging markets like this, that's where you can apply the moving average crosses. So another thing that you can use, it is to use them as a trend line. For an example, here, to trade a trending market, meaning you will be using the moving average bounce. Meaning when the market is in a trending mode, you'll be looking for places where the price bounces in the moving average until it completely crosses the moving average. That's where you'll stop looking for the bounces, because it will be showing you that price is on the opposite side. So meaning here it's a moving average bounce, here bounce, here bounce, and not, you'll be using all of your moving averages, because they'll be different depending on which periods do you choose to use. I didn't say go and use period 9, 14 and 24. I'm just using this for educational purposes. But when you use your moving average in these cases, you are going to be looking all of your moving average. They are going to be acting as your trend line until maybe price comes below, then you'll be looking forward for the opposite direction, for an example here and here. So which means when price bounces in the moving average, it's your end. When price bounces, not when price touches your moving average, but when it bounces, meaning when it shows signs of reversing, not just when it approaches the moving average. So this is how you can apply this wonderful tool. So thank you for watching this video. Remember to subscribe, share and like this video. Thank you.